First blush for the numbers, is this sustainable?
I hope so, because they're not that great. I mean, I know they're an improvement, but if you look at the 50-year average, the 50-year average is 1.5 million housing starts. So even in a lackluster, moderate year, we were still producing more homes than we are right now, and that's with less population. So I'm not impressed by this number. It's going to be a very slow crawl for housing. It continues to be, and it's really not a cyclical issue again. This is structural. It has to do with building costs, labor shortages, even immigration policy. These are all big headwinds to builders right now. And so I'm glad it's improving, but I'm not impressed with the number.
Okay, so Nela, you know this so well. I'm going to put up a chart. I think probably we borrowed it originally from you. It's not 50 years, it's 10 years basically. But what it shows on the top line, it is the housing prices, which are coming down, in fact. And the white line in the middle is building permits, which is just wandering around, not really going much up or down. And then the 30-year mortgage had come up some, but now it's going back down, which should stimulate house buying. So explain those numbers. What's driving this right now?
Well, the mortgage rates are great for the consumer, and so that's what's going to keep consumer demand robust. It's under 5%. I remember 2 years ago we were thinking rates would go above 5%. We haven't seen that happen at all, so that's good for the consumer. But what's wrong with the housing market is this mismatch between where supply is, which is at the high luxury end, and where demand is, which is at affordable starter homes. The missing question within all those charts is affordability. Prices kind of outran wages. Wages have been very slow and moderate, even though we have a tight labor market, and consumers haven't been able to keep up with high house prices. And that's why you see these lines telling different stories.
Fair. Yana, from where you sit, the home builder index for the ETF is up 23% so far this year. Are you a buyer here of that, or do you need to be a seller?
Well, the market as a whole has done a lot of work, and I think most of that is definitely multiple expansion. So again, I think being selective within the consumer space, particularly as it relates to home retailers, home builders, and repair and remodel is extremely important. I think if you look at the healthiness of the consumer, you can also extend it to other areas of the market outside of just the consumer discretionary and even consumer staples, and think about areas like healthcare that actually have done the opposite. They've trailed the market. They're down quite considerably relative to the market, over 13% or so. And more importantly, I think the elasticity of demand as it relates to healthcare service and biopharma types of goods is much more steadier, no matter what the tariff picture looks like or the macro backdrop.
Yana, within the realm of home building, do you differentiate between multifamily homes as opposed to single family? Because if we put up numbers that show renting versus buying, the renting seems to be coming up as the buying is going down. Does that create an opportunity?
So we can't really comment on specific names, but you correctly noted that, one way we're investing in our focused growth portfolio is through the second derivative. So if you have the housing and the permits pick up, what, should pick up post that. And obviously that's the spend in the big box retailers and again, the repair and remodel market. And majority of the spend once you're in the house is doing all the upkeep that you'd like to do. So we're kind of playing it through the second derivative and not outright home builders per se.